Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today we're diving into TriNet's latest financial report, and let me tell you, it's got a few twists and turns. Think medical bills and employee costs meeting a bit of an economic slowdown. TriNet provides HR services for small and medium-sized businesses. They handle things like payroll, health insurance, and all those complicated HR tasks. So how did they do this quarter? The top line numbers show a mixed picture. Total revenue in the first quarter of 2025 was just over $129 billion, a slight increase of 1% compared to the same time last year. But the real story is in the profit numbers. Net income, or the actual profit they pocketed, was down 7% to $85 million. Adjusted net income, which tries to smooth out some of the accounting bumps, also fell by 11% to $99 million. One reason for the profit dip is that TriNet had fewer employees on average working for their client companies. Their average number of worksite employees, or WSEs, dropped by 2% to about 349,504 in total full-time employees. Fewer people generating revenue for TriNet. Here's where things get a bit sticky. TriNet's insurance costs are a big part of their business. The insurance cost ratio, or ICR, which measures how much they pay out in insurance claims compared to what they bring in from insurance services, went up to 88%. That's 2 percentage points higher than the previous year. What this means is that medical expenses, higher rates for services, and expensive specialty drugs are cutting into their profits. Let's look at where the revenue comes from. TriNet has two main sources: professional service revenues, or PSR, and insurance service revenues, or ISR. PSR, which are fees for things like payroll processing and HR advice, actually went down by 2% to $209 million. ISR, the money they make from insurance-related billings, barely budge, increasing only 1% to $1.065 billion, but increasing only 1% to $1.065 billion. Now let's talk about cash flow, which is the lifeblood of any company. TriNet's net cash from operating activities, which shows how much cash they're generating from their core business, increased slightly by 4% to $95 million cash, mainly for buying investing activities, used up $8 million in cash, mainly for buying investments and equipment. Financing activities, which include things like stock repurchases and paying dividends, used a whopping $94 million. But investing activities used to include things like stock repurchases and paying dividends, used a whopping $494 million. Looking at the balance sheet, cash and cash equivalents, or readily available money, decreased slightly to $30.49 million. Total assets also took a dip, going down by 8% to $3.75 billion. Debt remained steady at $90.83 million, and total stockholders' equity, or the company's net worth, decreased by 9% to $63 million. TriNet uses some non-GAAP measures, which are ways of looking at their financial performance that aren't strictly by the book or GAAP. One of these is adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, with a few other adjustments. Their adjusted EBITDA was 160 tweaks from the previous year. Drilling down on the numbers, TriNet actually gets revenue from two types of users: those directly employed through their platform and those using their platform for HR tasks. The average number of platform users increased. This change in mix impacts their revenue and how they price their services. The insurance cost ratio is a critical performance measure for TriNet. A higher ICR, like the one they're seeing now, means they're paying out more in claims than they're bringing in through insurance fees. They attributed this to more severe medical situations, higher prices for medical services, and increased use of expensive specialty drugs. TriNet breaks down the factors that influence their revenue into volume, rate, mix, and HRIs, their cloud services. Volume is about how many employees are on their platform. Rate is about the pricing they charge, and mix is about the types of services clients are using. Revenue increased largely because of rate increases, but volume of employees was lower and ate into that increase. TriNet's effective tax rate, which is what they actually pay in taxes as a percentage of income, decreased slightly from 27% to 26%. This was mainly due to more tax benefits from certain income and a lower state tax rate. The cash flow statement shows the movement of cash in and out of the company. Cash from operating activities, which is a sign of a healthy business, increased. Investing activities like buying securities used up cash, while financing activities like buying back their own stock used up a lot of cash. They sold one of their businesses and got just $1 million out of it, which didn't impact things much. Under agreements with insurance carriers, TriNet needs to keep a certain amount of money as collateral, kind of like a security deposit. This amount is held in restricted cash, cash equivalents, and investments. Their financial assets are valued using what's called fair value, which is what they could be sold for in the market. They use different levels to determine fair value depending on how easily they can get market prices. TriNet is also involved in legal matters and claims. They don't think these will have a big impact on their finances, but you never know. Finally, TriNet is restructuring their business. This means they're making changes to focus on their core business, like ending their software-only HRIS product and cutting costs. They expect to keep incurring restructuring costs for a while. Now, what do we make of all this? TriNet is facing some challenges. It's not growing as fast as it used to, and medical costs are squeezing their profit margins. On the plus side, they're managing expenses and returning cash to shareholders through dividends and stock repurchases. But the big question is, can they get their costs under control and find new ways to grow their business? The rising insurance expenses and reliance on increasing insurance prices to keep revenues afloat can be concerning, as high prices can drive their customer away. However, the restructuring initiative and focus on a service-first approach instead of relying on software only is positive. If TriNet can stabilize its expenses, find new growth opportunities, and keep a strong customer base, a target price range would be $75, $85. Thanks for watching, and don't forget to hit that like button, leave a comment and subscribe for more deep dives into the world of corporate finance.